31st July is the last date for filing income tax returns for FY22. And needless to say, it makes sense to file your return at the earliest to avoid any last-minute mistakes. Now, first up, you need to select the right ITR form based on the source of your income, total taxable income, your origin of the income, whether it's domestic or foreign, assets, and so on. Now, this year, the ITR forms have a few but significant changes that one needs to take note of. Let's look at the key changes and the form that will suit you best. Of the 7 forms notified by the CBDT, ITR 1 to ITR 4, now these are the ones that are applicable to individual taxpayers. ITR 1 is if you are a salaried individual and your total income for FY22 was up to 50 lakh rupees. The definition of salary here also includes income in the form of a pension. You can also file a return in ITR 1 if you earn income from other sources like interest from bank deposits and one house property. Also, if you have agricultural income of up to 5,000 rupees, you can use ITR 1. There are a few new disclosures to be made this year while using ITR 1 forms. The ITR 1 form requires details regarding retirement benefit accounts maintained in notified countries under Section 89A, whether it's Canada, the US, and the UK. Now, this amount needs to be included in the net salary. The form also requires information of income from retirement accounts maintained in other foreign countries. These disclosures should be made in ITR 2 forms as well. You can use ITR 2 forms to file your return if you have income, including those qualifying for ITR 1 forms, and income from capital gains, income from more than one house property, foreign income, foreign assets, or if you hold directorship in a company or unlisted equity shares. Now, this year there has to be a separate disclosure of interest accrued on PF contribution to the extent taxable. Now, this is because any interest on an employee's contribution to PF over 2.5 lakh rupees shall be taxed at the hands of the employee year after year. The taxable component is the interest on the excess contribution and not the entire contribution. The excess contribution cannot be taxed twice as the contribution made by the employee is already taxed in the hands of the employee in the first place. You can file your return in ITR 3 form if you have income mentioned in ITR 2 and or have income from a business or profession. You should also use ITR 3 if you are a partner in a firm. There is now a new field that requires taxpayers to intimate the date of commencement of business. In case of non-residents, the form requires reporting on significant economic presence, SEP, as well. Typically, non-residents are also taxed in the countries they live in. However, the SEP rule is meant to establish how deeply the NRI's business is connected with India. Return on income can be filed in ITR 4 by resident individuals, HUFs, and firms other than LLPs with a total income of up to 50 lakh rupees and having an income from business and profession, and if you have opted to file the return under the presumptive taxation scheme. In this year's form, if you are a pensioner, you have to specify whether you're a central or a state pensioner. If you select a wrong form, it can lead to non-disclosure of certain sources of income as each form has a purpose. The income tax authorities will consider the return filed as defective and a notice will be sent to the assessee to file a revised return within 15 days. And if you fail to do so, the return will be treated as invalid.